Good afternoon, everybody. It's a great pleasure for me to welcome everybody to today's event. I'm Alan Barrett. I'm the Director of the Economic and Social Research Institute, and I'm joined by Minister Paschal Donohoe, who of course is going to give a speech in a couple of moments on Beyond the Health Pandemic, what does the future hold for the Irish economy? So Minister, just before getting into the details of the speech, can I just say what a pleasure it is for the Institute, I'm going to say, to host this event. But of course the Institute is getting off very lightly because we said we're hosting, but we're actually availing of your hospitality because we're here in the Department of Finance, and of course we're in the Whitaker Room in the Department of Finance, and it did strike me that there was something very appropriate about this. As many people tuned in will know, Dr. Whitaker established the ESRI in 1960 while he was Secretary General of the Department of Finance. And I think beginning then, and for many, many years since, there's been a very, very close relationship between the Department of Finance and the Institute. And actually, in many ways, that relationship has become more focused in recent years, because as you know, we have a joint research programme between ourselves and yourselves. And certainly during the Brexit period, I know we're still in it, but a lot of the analytical work around the macro modelling of Brexit impacts was done jointly, indeed, between ourselves and the department. And again, a little bit more recently, we had a joint paper between ourselves and yourselves on the joint impact of COVID and Brexit. So there's still a really sort of strong and healthy interchange between the Institute and the Department of Finance. So it's very nice for me to be, to have a chance to say thanks to you and your colleagues for all the engagement.
And it's a relationship that we really value, and it's a great pleasure to be able to welcome you here, Alan, into this room, and also to recognise all the great work that I know Sean Driscoll is now doing with you as well. And the relationship between the Institute of the ESRI and the Department of Finance is one that's really important to me as Minister for Finance. And we all benefit from the work that the ESRI does across so many different areas. And I always really enjoy the engagement that I have with the Institute, and always find something so worthwhile from it too.
Very good. Okay, well, thanks for that. So I'm now going to invite you.
This is the nearest you or I may ever get to the Golden Globe, doing something like this.
Well, I've higher ambitions now, okay. I have to say. You can speak.
There's me put in my place, Alan.
Yeah, so obviously the speech, as you'll see, will deal very much with the economic dimensions of COVID and the lockdown. I think we all accept, of course, that it is the health dimensions that are uppermost in a lot of our minds. But having said that, there is a host of economic issues, and in many ways, you can break them down into a sort of a number of categories. I mean, we're still in the middle of the lockdown and the crisis, so there's all the issues around the supports that business and individuals require. But of course, at the same time, we are doing things like building up significant amounts of debt. We're watching people who have now been out of work for very, very long periods of time, and we're worrying about the possible scarring effects both on individuals and indeed on businesses. There's a massive amount of policy innovation in both the fiscal areas and the monetary areas. So there's a whole host of issues that we need to sort of grapple with. So the Minister is going to touch, I know, on a whole range of these topics in his speech, and then when he concludes, we'll have an opportunity for a questions and answers session. So for those of you who are tuned into the live stream, there should be an option on your screens there to submit questions. So please feel free to do that, and I'll do my best to summarise and basically sort of pass those questions onto the Minister in a number of moments. But with that, it's a great pleasure for me to hand over to Minister Paschal Donohoe. So, Minister.
Well, good afternoon to everybody. And again, I want to recognise and thank the ESRI for all of the work that they do, and to say how pleased I am to be working with them and to be addressing you all with their support this afternoon. The changes we have all seen over the past year have been so profound, and so many moments of that year will be indelibly etched into my memory. The moment I first heard of this virus, the moment the scale of potential harm and death became clear, and then as a member of the COVID-19 Cabinet Subcommittee since the inception of that subcommittee, the memories of so many difficult decisions that have had an impact on so very many. So in my time with you this afternoon, I will firstly emphasise the value of the foundations of the Irish economy and how they were recently strengthened. Secondly, recognise the unique nature of approaching challenges and, of course, opportunities. And then thirdly, describe how we can approach and how we can successfully overcome these challenges, while at the same time relentlessly pursuing many opportunities. Now, as Alan said a moment ago, the pandemic has indeed taken a toll on life and on so many aspects of life. But as Minister for Finance this afternoon, I want to address with you the economic consequences of the pandemic. And as we turn the page on one of our most turbulent years ever, we have seen our jobs market, our labour market, has also been turned on its head. Now, to put a few figures on this, there are over 1 million of our fellow citizens on some form of income support from the state. Nearly 500,000 receiving the pandemic unemployment payment, another 350,000 of our fellow citizens being supported by the employment wage subsidy scheme, and nearly 200,000 on the live register. But of course, the consequences on jobs have been uneven in several important respects. First, the so-called public-facing sectors of our economy have fared worst. And what we mean by that is really important parts of our economy and our society in hospitality, in leisure, in personal services that require face-to-face interaction and are less conducive to e-commerce or social distancing than, say, office working or parts of manufacturing. And this is why business closures and job losses have been concentrated in these sectors. To put this into perspective again with numbers, the number of hours worked in the food and accommodation sector fell at an annual rate of 53% in the fourth quarter of last year. On the other hand, hours worked in the information and the communication sector, which are of course far more compatible with remote working, rose by 3% over the same period. The second distinctive impact, and such an important one, is the disproportionate effect on younger workers. When we include PUP recipients in our figures, the unemployment rate in the 15 to 24 age cohort rose to 46% in the fourth quarter of last year, compared with a total unemployment rate of 19.8%. I recognise the contribution that our student population make to those figures, but the broad relationship still stands up. And this, of course, is because of the higher incidence of youth employment in the contact-intensive sectors of our economy, often indeed in part-time work or entry-level jobs. Thirdly, employment data also shows that workers with lower levels of formal educational attainment have borne the brunt. This is not unrelated again to the sectoral nature of the economic shock. For instance, the number of persons engaged in paid employment without a third level qualification fell by 10% over the year to the fourth quarter of 2020. For comparison, and again bearing in mind some measurement challenges, the numbers with a third level qualification engaged in paid employment actually grew over the same period. So in designing our long-term and our active policy response, the really uneven nature of this shock is so important. To put it another way, this time last year, the thinking at that point in this room 12 months ago was of a system-wide symmetric shock. It now appears that it could be more of an asymmetric, sector-specific shock with unique impacts. However, The scale of these impacts is so large because these sectors employ so many and they're so important to our economy and to our society. So in recognition of this, the government responded rapidly, bridging through to the recovery by putting in place a range of supports for both firms, for workers. The overall objective has been to support households, to support employers, as well as to limit the so-called scarring or permanent effects of the pandemic. In terms of quantum, around €38 billion of government resources, of your money, has been used to date. It's around 18.5% of modified gross national income, and the scale and design compares favourably with supports provided in other jurisdictions. An important consequence of these payments, which we can understand further indeed due to the recent work of the ESRI, is that household income, at least on the aggregate level, actually increased last year, albeit, of course, with the cost that I mentioned a moment ago. Indeed, data from the CSO show that during the most severe phase of the disease a year ago, during the second quarter, median household income fell by just under 2%, once government supports are included. The counterfactual scenario, in which no support was provided, would have resulted in a 20% decline in median household income. With supply-side restrictions, the temporary closure of leisure, of hospitality and many parts of retail, the fall in consumer spending has been far greater now than the change in household income. In other words, households, again in the round, have accumulated a large quantum of savings. The so-called savings rate, that part of disposable income that's not used to purchase goods and services, reached record levels last year. In the second quarter, for instance, the average household saved €4 out of every €10 of take-home pay. In normal times, it's €1 out of every €10. To put it another way, of the €126 billion of household deposits in the domestic banking system, around 15 billion of these have been accumulated in the last 12 months. Most of this, the so-called excess savings. Now, it should be stressed we're not unique in this regard. Indeed, the same pattern was seen in almost all advanced economies last year, though not to the same extent. And importantly, this means that once the virus has been contained, the unwinding of the savings ratio will provide some support for the economic recovery, at least in the early phase of it. This extraordinary response, though, from the government, this extraordinary counter-cyclical response from the government, was possible for two reasons. First, the careful management of our economy in the pre-pandemic period, and secondly, the favourable sovereign financing conditions associated with monetary policy. With regards to economic management, the public finances had been put on a solid footing in recent years. Budgetary surpluses were recorded in the 2 years preceding the pandemic. Before that, a low deficit was ran, that was then eliminated. And indeed, we had been running primary budget surpluses since 2014, with current spending increases in line with the trend growth rate of the economy. We established a rainy day fund. As importantly, the sort of macroeconomic imbalances that we experienced a decade ago were not evident on this occasion. There has been no credit bubble, for example, illustrating the value of our macroprudential rules. Coming into the great financial crisis with annual credit growth of around 25%. In recent years, it was broadly flat. The structure of our tax system has played a very important role. We weren't dependent on transaction-based taxes. And this shows the importance of maintaining a broad income tax base with a progressive rate structure. It's one of the reasons why our tax revenue has held up so well in the past year. For instance, total tax fell by just 3.5%, and notwithstanding the fall in employment, income tax fell by just 1%. None of this happened by accident. The regaining of national creditworthiness, the careful management of lending, and the maintenance of sensible taxation structures during a period of economic growth were all political decisions. They mattered. Their absence would gravely deepen our national economic challenges. Taking them as a given is to ignore their value in our efforts to rebuild. But obviously, the European context is essential too. Ireland, like every euro area member state, has benefited from the European Central Bank's Pandemic Emergency Purchase Programme. The most recent figures, which relate to January of this year, show that the euro system has purchased just over €10 billion of Irish sovereign debt since its launch last March. To put it another way, the central bank is now the largest single creditor to the Irish government. Additionally, by activating the so-called General Escape Clause of the Stability and Growth Pact, the Commission has allowed member states to temporarily deviate from their budgetary requirements in order to take the necessary measures to affect this pandemic. So while ECB support helps to lower interest rates, it is important to remember that budgetary policy that focuses on short-term counter-cyclical support and long-term sustainability plays a role in keeping those rates for our nation lower. The careful management of our national finances that preceded the pandemic meant that we entered it from a position of strength. Equally, European institutions like the ECB, the Commission and the Council have responded in a really different manner to this crisis than that of a decade ago. In large part, these advances have been forged at the political centre, both in Ireland and within the European Union. This is because the centre is not the same as the status quo. It digested, it took on board the social and political lessons of the financial crisis. It built a stronger institutional architecture to prepare for the next one, and it understood the social and political consequences of failing to meet the needs of its citizens at a time of the greatest challenge. And it is from the centre that we will build back again when we've beaten the pandemic, while also responding again to the new lessons and risks that have been central to this crisis. And to emphasise that once the extraordinary monetary supports are phased out, the benefits of careful economic management pre-pandemic, alongside determined counter-cyclical support during the pandemic, will become evident. Of course, right across the world, activist fiscal policy has been the order of the day. All of the different agencies, all of the different international organisations that provide advice, from the Commission to the IMF to the OECD, take the view correctly that because the crisis was not caused by underlying economic imbalances, such as credit growth or the wrong budgetary policies, the correct response is for governments to deploy their balance sheets in a proactive counter-cyclical manner. It's why we've seen a surge in public debt. And in effect, the two main macroeconomic stabilisation tools, fiscal and monetary policy, are working hand in hand. But of course, monetary policy has complemented this support because it has enabled a falling debt service burden. There are several reasons why this active fiscal policy is now essential, and why it needs to complement the role of monetary policy, particularly now. First, and obviously, the scale of this crisis, without precedent in our lifetimes, requires an aggressive, large policy response. Second, monetary policy's capacity to respond is constrained, at least in part, by the zero lower bound for interest rates. In theory, of course, the short-term or policy rate could be moved into negative territory, but this would have other significant side effects, including by further affecting the business models of the banking system in a market economy. And then thirdly, and for me the most importantly, the shock is, as I noted earlier, asymmetric. It varies across our society. Indeed, anyone who's able to go for a walk within their immediate locality can observe this. So monetary policy works at the aggregate overall level, but beyond the financial sector, it can't target individual sectors. And this is where budgetary policy, fiscal policy, is better suited to supporting income and employment. And these insights guided the design and the implementation of this department of the Employment Wage Subsidy Scheme of EWIS and the COVID Restriction Support Scheme, CRIS. To date, the Employment Wage Subsidy Scheme alone has provided support of almost €2.5 billion, including PRSI relief worth €360 million to over 47,000 employers in respect of 532,000 employees. There are over 20,000 firms in receipt of the CRIS payment, with almost €330 million paid out to date. And this is because the nature of this shock won't extend just beyond the initial impact of today, but in all likelihood to the early stages of our recovery. At the same time, as it been clear, as the resilience of Irish GDP been clear throughout 2020, large components of the traded sector of the economy remained robust and are likely indeed to be further boosted by the eventual turnaround in the global economy. But at the same time, significant elements of our domestic economy remain effectively closed at the moment and do, I acknowledge, face uncertain futures for some time. Hence the need for targeted and for the continued state interventions to support workers and firms in these sectors, which we are deploying in huge scale now. This interplay between budgetary and monetary policy has indeed stimulated an important debate about the sustainability of higher public debt. This, of course, it's not just of interest to academics, to many of you, it has implications for all of us. In Ireland, the debt to modified national income ratio rose to 108% last year. It's set to rise further this year. Crucially, however, the low interest environment that we find ourselves in means that despite the sharp increase in debt, interest costs are actually falling. So again, to put figures around this, last year's interest bill absorbed 4.5% of total revenue. In 2013, the interest bill absorbed 12.5% of total revenue. This phenomenon is repeated across other advanced economies, including in the euro area, the UK and the US. Such shifts in the economic environment have led many high-profile economists and policymakers to suggest that traditional measures of assessing the burden and sustainability of debt need to be rethought. Jason Furman, Larry Summers in the US, for example, have advocated a move away from the traditional practice of analysing the stock of debt by reference to the flow of national income. Instead, they focus on comparing interest rate flows to revenue flows, a more like-for-like comparison. Olivier Blanchard, of course, has famously championed the R minus G debate of late, with great traction. All of these points are detailed and they're assessed in my department's annual report on public debt in Ireland. I published this a few weeks ago. And this emphasises that there's no single metric that shows whether a country's debt is sustainable or not. But if we accept the premise that flows, the interest bill, matters more, then it is equally valid that other flows, namely the deficit, also matter. The idea that deficits don't matter, especially for a small economy without the possibility to print its own currency, is so far off the mark as to be dangerous in evaluating policy options in the future. In other words, keeping the interest bill down will depend on reducing the deficit at the appropriate pace and at the right time, and then setting out a clear path for its reduction and for its elimination in the future, particularly for funding our day-to-day spending. Maintaining the public finances and the interest bill in particular on a sustainable path is particularly important within a monetary union where monetary policy isn't always optimal for a small country. So while the policy framework with respect to deficit and debt is evolving, it doesn't absolve us of the need to reduce our deficit over time. Yes, we absolutely have to provide counter-cyclical support for our economy. We need to ensure that it's sustainable. And there is indeed a new balance that we are striving to attain. To sustain our debt, to manage our deficit, we need economic growth. That economic growth requires employment growth. And that is why we have in place such strong support for income and for jobs. And to be perfectly clear, for fear of being misinterpreted, these supports are essential. I know their value, as in collaboration with other colleagues, I introduced them. To withdraw them too soon, in a premature way, would be damaging indeed to our national finances, due to the likely harm caused to jobs and to income. And I know this from the very regular engagement I have with the Irish business community. But it's important also to emphasise that at a point, the need to manage our national finances differently will emerge. And it is in our interests to be ready for that moment. This undoubtedly will be the subject of continued debate, as it should be. But a truth is that nobody for certain can know the future path of interest rates. Indeed, it is notable that inflation rates in many countries have picked up in recent months. This has been accompanied by increases in inflationary expectations as market participants have priced in higher inflation rates in the coming months. But there are two things which we do know. First, the higher the stock of public debt which you are carrying, the more painful any increase in borrowing costs can be. And secondly, the more carefully and credibly a national deficit is managed, the better the prospects are for more affordable costs. So, the policy challenges are indeed very complex. We've navigated our economy and society through some serious challenges before, and we will do so again together. And as President of the Eurogroup and a member of the G7 Finance Minister Group, I am privileged to play a role in the coordination of our efforts across Europe. At a European level, I welcome yesterday's Commission communication on the fiscal policy response 1 year since the outbreak of COVID-19 and the Commission's preliminary indication in relation to the General Escape Clause. This statement provides much needed clarity for Member States as we all work to navigate through these uncertain times. From a Eurogroup perspective, we will reflect closely on this communication in our meeting in a week's time, particularly into how this feeds into the coordination of budgetary policy across Europe in 2022. And while not preempting these discussions, I anticipate that this very important communication will provide the basis for continued agreement on coordinated economic policy in the euro area. This could build on our assessment last December, which at the time focused on the need for a supportive fiscal policy stance. We'll discuss this in March and again during the summer. Also, at a European level, there's much important work to be done, such as, for example, the National Recovery and Resilience Plans. Following these, the Commission will provide new forecasts in the spring, and then fiscal policy guidance as part of the European semester. All of these will be on the work plan of the Eurogroup through to the middle of this year and then into the first half of next year. At a national level, the government will bring forward a national economic plan and a medium-term plan on our budget strategy, as noted for and provided for in the programme for government. The programme also provides for the establishment of a Commission on Taxation and Welfare to review and make recommendations on our taxation and our welfare system, the value of which is being reminded to us today, as we see how important they are to us as a society. So it's important that we review how well the systems we have today are meeting our needs and their sustainability to meet the challenges of tomorrow. The global reach, in conclusion, of this disease has altered how we think about uncertainty, and in particular, the so-called tail risks, the black swans. Just 12 months ago, no one would have believed the year we were about to endure. In order to reduce the vulnerability of the economy and the public finances to some of this uncertainty, a plan for the future, for our deficits, for our debt, and how we manage our economic supports, and how we ensure they contribute to the retention and the growth of employment are now key priorities. This will once again provide us with options should we face further challenges. But there is much we can build upon. Vaccinations are now being rolled out across the country, and the beginning of the end is hopefully now in sight. Many of our youngest girls and boys returned to school earlier this week, and all going to plan, even more will return in mid-March. So yes, the challenges are great, but we have achieved much, and in our national efforts to prevail over this disease, we will achieve more. Thank you.
Well, thanks so much, Minister. That was a fascinating speech, covered a huge amount of ground, and it certainly prompted an awful lot of questions in my head, and I'm going to be asking some of them. But as I indicated earlier on at the outset of this event, if people would like to submit questions online, we'll try and factor those into the discussion as well. So let me kick off with a couple of questions, Minister, and I'm going to sort of give you a sort of a thought experiment, okay, that I want you to react to. So the thought experiment I want you to engage in is I want you to think about what do you think will be the tax as a proportion of GDP take in 2025, okay? And the reason I want to get you to sort of think about this is it strikes me number of things are happening here concurrently, okay? So the fact is, if we go back to budget 2021, there was a lot of additional expenditure. A lot of it was COVID related, but there was a lot of additional expenditure there as well. I think it's also the case that a lot of people worry that, you know, even as we come out of the COVID situation, there'll be a huge amount of requirement in areas of social policy to fund the sort of actions that, you know, to take account of the asymmetric effects of COVID. So I'm just going to take a small example. If you think of all the, you know, the kids who have been out of school and the differential impact on children, rather than them all going back, I think, you know, collectively we understand as a state that we're going to have to try and devote resources, additional resources, to looking after people. and getting them back to where they otherwise would have been. And I think there's probably this broader sense that people got used to higher levels of government intervention, be it from the health system to a whole range of other things. If you take the way the PUP payment was put at a higher rate than other social welfare payments. So it seems to me that there's a huge number of factors that are combining to sort of bid up the expenditure side. And taking your comments then on the need to ultimately reduce the deficit, if you project forward, as I said, to 2025, so about a sort of a 5-year, are we looking at an increase on the expenditure and indeed the taxation side of the sort of the government's fiscal ledger?
You're talking about to look ahead to 2025, Alan.
Yeah.
In truth, I'm focusing at the moment and trying to answer those kind of questions regarding challenges we're going to have for this summer. Mm-hmm. And I think it's really important that in a speech that has just acknowledged the uncertain environment that we're in an effort to answer really, really thoughtful questions like that, I don't overstate how much certainty we have about our ability to plan that far ahead. There are so many unknowns and so many bridges that we have to cross before we get to 2022, let alone to 2025, that it's so difficult to answer that question. All I can do is say to you that clearly there is a level of increased expenditure that we can pay for through our economy growing again. And if you look at where we have been in recent years, our state did get bigger year after year after year, because we had a level of planned expenditure, and at times even a little bit that was unplanned, that was funded by an economy normally growing, while also allowing us to do some things on taxation and social welfare. So I think the question then becomes, is there a level beyond an expected degree of state growth that has consequences for where we're going to be on taxation and other decisions we therefore don't make? And we will have to have that debate as we approach that point. But for me to be able to tell you what I expect tax as a share of national income to be in 2025...
Would you think it will be bigger?
Given the environment we're in at the moment.
Yeah, but I take it from what you're saying that you assume it will move in the direction that the state will get bigger and that tax as a proportion of GDP probably will increase.
Well, we have seen an incremental growth in where tax as a share of national income has grown. I think it's very likely that that steady pace will continue. But as to what the degree of accelerated growth could be, at this point in time for me, it's far too early to give a view as to what that figure will be.
Sure.
I think it's likely we will see continued growth for the reasons you've talked about, but the degree to which that continued growth is bigger than the ability of the growth of our economy to pay for it, there's so many different variables before I can honestly answer that question.
Okay. Well, listen, I'm going to ask you to speculate a little bit further once again. So apologies.
This is where we get into the realm of challenge here, because speculation is great for you.
Well, no, it's not.
Because as Minister for Finance and as somebody who is working with the advice and insight that's always offered by the ESRI in many of these challenges, speculation itself is very helpful for looking at choices that we would make, but I then have to make the decisions. But
sure. With
that caveat in mind, over to the next speculation.
Okay, well, let's go on to a sort of a rather different area, okay, and it's the banking system.
Yep.
I'd like to sort of talk about for a couple of moments. And you remember sort of going back as we emerged from the great financial crisis, again, there was always this question as to whether or not the banking system was going to be sufficiently robust to lend to the recovery. That used to be the phrase that was there, and there was sort of genuine worries about what could happen. And I suppose, partly as a result of the Ulster exit last week, people do seem to be worrying, increasingly about the roles that banks will play and that our system will play as recovery begins. I won't ask you to speculate in a narrow sort of sense, but I think it is reasonable to assume that there will be defaults, both at, particularly at an SME level, so there will be pressure on the banking system. So are you confident now that Ireland's banking system can contribute and support recovery in the way that we would typically hope?
Yes, I am. And I am confident for one reason that relates to our banks and another reason that relates to other things the government can do. The reason why I am confident of the ability of our banking system to contribute to economic growth is because of the amount of money that our banks currently have on their own balance sheet and what that means for their resilience. And we entered into this great crisis with the capital requirements for our banks at a very high level, and that is playing a role in our banks being able to deal with the challenges that they're now facing. The second reason, however, why the answer to that question is also yes, is because a key feature for me in budgetary choices that I make is trying to support employers and firms that are otherwise viable to a better future. And by doing that, of course, that also is a way of avoiding some of the difficulty that you touched on a moment ago. But that's not the main reason I do it. It's because I want to support employers. I want to support jobs that will come back. So if I could offer a thought experiment of my own, which is that if we didn't have EWIS in place, and if we didn't have the COVID restriction support scheme in place, that many of the concerns that you're having could be heightened or even indeed happening. But because they're in place, we're able to offer a different kind of support. And that's a very important factor for me in, for example, the decision that we've made to extend many of these schemes up to the end of June. And it's why, for example, we introduced the COVID restriction support scheme actually in the middle of the most intense phase of the crisis. So there will be another form of support coming in at a different point than the start to help to provide an additional level of support.
Okay, I'm going to look at the screen and see if there's a question or two coming in. Okay, so I think that one of the ones, I'm just sort of scrolling through them here, really seeing them. So we've dealt a little bit. There's somebody who's asking you to be even more speculative on debt to GDP ratios in the future. So
I've seen that question.
Yeah. So another one, so you're highlighting three groups which have suffered disproportionate burdens. Another group which has borne a huge burden is women. And to what extent is the gender perspective addressed in policy making? An interesting question. Would you like to take it?
Yeah, a really important question, and one that we had done preliminary work on in the last government, much of which was influenced by Minister Sapone, who really pressed this very effectively as something that we needed to give greater recognition of. And what we are now doing through Minister Michael McGrath and his work in the Department of Public Expenditure is we're now looking at alternative budget measurements and alternative ways of measuring outcomes that better recognise the issues that was raised there by the viewer of this event. Because absolutely, how we recognise that the effect of this crisis has been uneven and it's affected all of us in different ways is critical to ensuring that we'll have a recovery as opposed to a rebound. And as we work through this year and get ready for next year's budget, we will in particular give even more consideration to that point.
Mm. I see another one, actually. I'm glad I can blame the questioner for this one now. You can't have a go at me over asking you this one. But it's basically about the public sector pay award, the recent agreement, and a figure of 900 million has been mentioned. Yeah. So it's a standard question that you'd be asked. It's a protected group being given that amount of money, and how would you justify it?
And I think that question is coming in from Jack. So just to acknowledge that there. The reason why I would justify it is, for example, those who are receiving that additional pay across the next 2.5 year period. There are teachers who are in our classrooms at the moment. There are guards who are stopping us at COVID checkpoints, who are dealing with really difficult situations. There are nurses and doctors. And these are the public servants that have been on the very, very, very front line of keeping us safe. And our public services went through an extraordinary period of challenge and change, and indeed still are. And the first part of the wage programme that Jack is referring to is going to be coming in towards the very end of this year. And I strongly believe, as did the government and as did Minister McGrath, that the agreement got the balance right between recognition of their unbelievable efforts and also the need for it to be affordable and the need for it to be also an agreement that recognised that many are facing much challenge in our society at the moment.
Okay, thanks for that. Now, I see another question from John, and it's about inflation, and I'm going to sort of just draw it out a little bit.
Yeah.
Okay, and again, I know you may sort of say, well, this is more speculation, but I think this is something that is actually worrying an awful lot of people, and you did sort of touch on it in your address. So the way the question is framed there, it's this question about, and again you mentioned it, this glut of savings that's going to arrive in the form of demand probably pretty soon. At least we hope that would be the case. But of course the other part of this, and again you mentioned it, is the extraordinary amount of monetary accommodation of all this spending that's going on. So a lot of people are beginning to worry about inflation and what this might mean. I mean, even from your discussions with your colleagues in the Eurogroup and stuff like that, would you even sort of give us a sense of whether or not this is a worry that's on your agenda?
It's a concern that is always on our agenda, and obviously it's central to the work that the European Central Bank do. And we are all aware of the potential for inflationary trends to develop for many reasons that you've touched on, and of course also the capacity constraints that are in place in many parts of our national economies at the moment is another factor there. I think at the moment though, it is not an issue that is in any way as preeminent as the challenges that we have in getting economies back to work. And at the moment, my calibration of it as an issue is one that is still potential, and there are many, many other challenges that we have to deal with before we get to the point, I think, of that escalating. But as always, to go back to my point about uncertainty earlier on, this is where you get into that phrase that is really relevant to this, which is it's something that we have to monitor regularly, because even now, some of the inflationary trends that are developing in some parts of the world, while they are still fully explicable, the changes that have happened have been quite pronounced month to month. And obviously it's something that will merit continuous tracking and evaluation. But for me at the moment, there are a few stages and a few big challenges to deal with first in case that does develop.
Yeah, it's. I agree entirely. It's a very tricky one to deal with, but I was struck by the UK budget yesterday. So, not suggesting for a moment that you, as the finance minister, would do this, but the chancellor, of course, is freezing. The bans and the allowances and stuff like that. And of course, there are periods. Sometimes inflation is very helpful to finance ministers, including reducing the total. The real value of the national debt. So I'm not going to ask you to comment on that or anything like that, because I have a feeling you might not do it.
The only thing that I think could be interesting from a European perspective is the degree to which incomes have been protected in the first place affects the base of which you then look at income trends. But look, that indeed is a matter for us to track very, very carefully, and there are some effects of inflation, as you said, and what can mean for debt sustainability and for nominal growth overall.
And again, I think
that are different.
Well, I think the other thing looking ahead, which I'll do for a brief moment, is to say that clearly monetary policy, I think you use the phrase working hand in glove at the moment, monetary policy and fiscal policy. But I'm conscious, I think you and I both studied economics as undergraduates in Trinity, so I could hear some of the people who used to teach us these things, and they would have talked about monetary policy is often a sort of a counterweight to fiscal policy, and the more normal run of events is that you have fiscal policy tending to be more pro-cyclical, and that monetary policy is often playing a role in the background, and hence the rise of independent monetary authorities. And I do wonder, if you're giving the speech again in a couple of years' time, if we will see the monetary authority sort of reacting to stimulus that might still be in place. So I don't know, do you want to comment on that at all?
The one thing I know is for certain is that in a few years' time, if I'm still in this room or even in a year's time, I have no doubt at all that the environment that we're going to be in will be very, very different to where we are today. And not just the speech, but I'm sure our policy response back will be reflecting that. But I mean, you're absolutely correct in what you said, which is that the mix now and interplay between budgetary policy and monetary policy is so different to what we have known now in recent years. And of course, and you know much of this so well, as will the ESRI, that is a reflection, of course, of the fact that the crisis is so completely different in terms of its origin and its scale. Within the Eurogroup, the speed with which a budgetary policy of real scale was deployed really reflected the nature of the crisis that we face. And of course, that was the catalyst behind the launch of the Recovery and Resilience Fund.
Sure. Now, I see another question actually, and it's from a colleague of mine, Kieran McQueen, at the ESRI. But again, I want to ask it because it is something I'm interested in myself. So the question is really about the fiscal rules. And actually, I remember when I was on the Fiscal Council between 2011 and 2015, we were grappling with the fiscal rules. But I do remember saying to my colleagues on the council at the time that the history of fiscal rules is that they always come and go. I think any country that has ever had a fiscal rule, at a certain point, it tends to fall by the wayside or get amended. And again, it's quite an extraordinary period, but we have rapidly, and quite correctly, everybody accepts that we've moved to, and you again touched on a speech, that really the rules have been suspended, if I can put it like that. But, and again, if I can ask you to speculate, do you think we'll go back to the fiscal rules as they were, or will there be a renewed thinking about the structure and even things like the 60% debt and all of those sort of things?
Well, I guess at this point I have to be conscious that while of course I'm doing this event as Minister for Finance for Ireland, I'm also President of the Eurogroup, and I have many different colleagues who have many different views on some of these issues. So just to make clear that I'm just going to answer this question from a national perspective.
Sure.
The first one is that I do actually believe that the fiscal rules as they were indeed currently structured did allow for increases in capital expenditure and did allow for increases in productive investment. So, for example, between 2011 and 2018, 2019, year after year after year, we had very, very, very significant increases in capital expenditure that were permitted under the fiscal rules as they were then. That being said, I do think we will all be looking at how can we ensure that the fiscal rules are clearer and simpler, because concepts such as fiscal growth, such as output growth gaps, and so on, we need to look at how we can make these more applicable and clearer to the decisions that policymakers are making. And then in the background to all of this as well is that the funding needs that in particular we're going to have to deal with climate transition and how we're going to need to fund that is a matter that is really on the agenda of finance ministers at the moment. And like what will be a really important point is later on in the year when Commissioner Gentiloni and Vice President Dombrovskis, they will outline some thinking they will have regarding, for example, do they recommence the consultation on the fiscal rules, or what are the kind of options they believe could work. And for example, I thought some of the work that Commissioner Gentiloni published yesterday, is going to merit debate and a lot of discussion amongst us. But the fiscal rules as they were then did allow for increases in capital investment. The question we will have to reflect on is, given the need that we will have for more of that, particularly in the green and climate setting, what does that mean for the rules in the future?
Very interesting. Okay, turning to another question from another colleague, Mark Regan. And we're really moving between the macro and the micro here, but anyway, you're smart, so you can handle this no problem. It's this old question that we know if you enter the labour market at the point of a recession, you tend to suffer disadvantage at that point, but the disadvantage tends to follow you right throughout your career. Very, very often people don't actually get back to where they otherwise would have been. And I think it goes back to this point again about the sort of the damage across a whole range of groups. Younger workers, kids from disadvantaged backgrounds, women were mentioned earlier on. And I don't expect you to sort of, outline the policy agenda here or anything like that. But is there a sense in government circles that we will need to invest to mitigate the difficulties that these groups have suffered?
Absolutely. And this is why, it would be, very traditional, and indeed at times I've done it myself before we got into this crisis, to be talking about the need for changing supports and pulling back as soon as we can. And in the speech, what I tried to do today is acknowledge that we've many different competing dynamics. Like the supports that we have in place at the moment are needed. They're playing a really valuable role. We've just extended them. And then I'm trying to indicate that at a point beyond that, we will have other challenges that will matter in terms of our national finances. And we need to be aware of that as we're making decisions now. But one of the reasons why I think it was Mark's question really matters is that it's not just what we may do in the future, is what we have in place at the moment to deal with the risk that Mark identified there. It's why we've kept the employment wage subsidy in place for so long, to in particular try to facilitate firms that are viable, that are hiring, that they're in a position where they continue to be able to do so. And a key fact behind the pandemic unemployment payment and bringing it in was, of course, recognising that many who were losing their jobs are, as I mentioned indeed in my speech, they're young, they're at the start of their career, and that the loss of income can have such a severe effect. And how we will develop that agenda further will be in particular through the work that Minister Simon Harris is doing in his department, which focuses on higher education, as opposed to just all the education we do at the start of our lives, to help recognise the challenges that people are facing who are starting their careers now and how they may need further support in the future. And absolutely, when I am looking at the role that the supports that we have in place will play, in the coming months and even beyond, the role of young people and the effect this pandemic has had on them is a matter I take really seriously.
Okay. We're coming towards the end, but I suppose just to give a more general question as we do come towards the end, I'm only going to ask you to speculate about the next 6 to 9 months. Are you optimistic about prospects for a sort of an end to the sort of the really dark element of all this? And in terms then of seeing at least the beginnings of recovery, and are you optimistic that there'll still be enough businesses reopening, there'll still be, the cities will become vibrant again? I mean, I think you're fundamentally an optimistic person, so I think I know the answer, but I would like just to hear your thoughts on the next 6 to 9 months.
So I am fundamentally an optimistic person and an optimistic politician. And having said that, I am optimistic, but I better give my reasons why that optimism is there. And there are 3 reasons regarding why I am optimistic. The first one is that I believe the vaccination programme that we have underway and the way we are implementing, though I know a huge social cost, our public health guidance, I believe that will work. And I believe in particular as we approach the pre-summer period, the vaccination infrastructure that we are building up, particularly at community level, will mean that as the vaccine supply increases globally, we will transfer that into a very effective vaccination programme. I believe all the foundations are being laid for that, and we will be able to do it. The second reason why I'm optimistic is virtually every week Alan, I meet a cross spectrum of different Irish firms and employers. And, you know, the innovation and the creativity of our economy and the way so many have adopted, particularly in our hospitality sector, to the greatest of challenges, gives me optimism for what we're going to be able to do when the disease lessens. And the performance of particular parts of our economy demonstrate that. But even the parts of our economy that are facing such challenge at the moment, the way our restaurants and cafes have changed, the way they've looked to new business models, does give me real strong hope for where we can get to. And then the final one is the economic policy decisions that we will make. And I believe at Eurozone level, and I believe at national level, we have the foundations in place to continue to make the right decisions about the supports that we're putting in place to help our economies through this. And I believe we will do that. So I know the demands are great at the moment. I know how weary so many of us are. I know so many of us are wondering, you know, how we'll ever meet our family again, how we'll ever be able to socialise again. Too many of us are reflecting on tragedy and grief of the last year. All of that is there. But I also believe in the months ahead, the way through this will become clearer. And I believe we will be on that journey and we'll complete it. But I always acknowledge in doing that, there will be challenges, there will be difficulties, and we'll have to work hard to support many. But because I think we'll be able to do that, we will get through it.
Very good. Well, unfortunately, we've come to the end of our hour. It's been really fascinating. I enjoyed the speech. I really enjoyed the questions and answers. It's been quite an honour for me to do this. So
thank you so much, Alan, and thank you for coming in. And look forward to meeting all of you in your building at some point.
Very good. And with that, again, I wish everybody a good afternoon, and we'll try and cling on to that optimism. So good afternoon.